Let's get in our guests as well. We have Dr. Deepali Pant Joshi, former ED RBI, Anindya Banerjee, SVP Currency and Commodities Research at Kotak Securities, and Gaura Sengupta, Chief Economist at IDFC First Bank, joining in to take this discussion forward. Deepali, let me come to you first. You know, with the kind of volatility that we are seeing right now when it comes to the rupee against the dollar, what is your assessment as to what's happening, what's leading to this, and what the RBI will do?
Okay, let me first come to the RBI point. RBI is the custodian and manager of India's foreign exchange reserves. Now, RBI does not support any level to the rupee. No central bank does. Because the minute you support a level to the rupee, you have George Soros, with apologies to George Soros, knocking on the door and trying to shift that. So that is one thing. The RBI will not, how does the RBI intervene? It intervenes in the spot and Forex market for buying and selling. We have at the moment a war chest of 688 billion in Forex. We have a suite, the habit of saying we is still there. The RBI has a suite of policy tools to manage currency volatility, and it has related accounting internally as part of its standard reserve management practices. Now, what has led to this? First of all, let's be very clear that the war chest is full. The balance sheet is completely bulletproof. We have seen currency crises earlier. We have weathered the taper tantrum when we did not have the cushion of 688 billion to fall back upon. So RBI is not going to step in. The central bank will step in. The more the speculators will attack the position the central bank takes. So what has led to this? Well, the importers are obviously rushing for cover. That creates a scarcity of the dollar. And the exporters also, what we call the leads and lags in the system. So the leads are the importers who are rushing in to cover, and the lags are the exporters who are trying to delay getting their money in. So that is exacerbating the situation. Why is the RBI not intervening? Good question. Because as it is, the exporters have had the whammy of the tariffs to deal with, and this is giving them some good leeway. And as I said earlier also, and as I maintain, that because we always tend to see the rupee against the yen, the pound, and the dollar. Why don't you see it against the Pakistani rupiah, which is 280.45 today, the Sri Lankan rupee, which is 308.50 today, and you are at 90.25. Now, if you become very strong, you're pricing yourself out of the international market, and you are all, remember, Pakistan, India, Sri Lanka are all tea, coffee, spices, rice, wheat, textiles, pharma, and cotton exporters. So you will lose market share. And you see, the thing is that RBI will definitely want to increase the export growth. And for this, it will request the government that the government itself will continue the export subsidies, which it is extending to the exporters. So there are a lot of positive externalities.
Right, Dr. Joshi. Thank you so much for that primer, because that's essential for this conversation. I want to go to Anindya. Anindya, the conversation about this 90, 25, 28, whatever, 90, 30 or level for the rupee, it's not so bad. In fact, it might actually be looking a little bit more interesting for exporters now at this level. How do you see this? In your view, are we close to that bottom for the rupee?
Right. Thank you for having me. See, the point is, if you look at this current USD situation through two lenses. First is macroeconomic. The second one is primarily the financial market. So first, macroeconomic, we generally use the RER model to understand where rupee stands vis-a-vis its peers. Now, this year, if you look at the top 26 currencies, Indian rupee is the second weakest after Turkish lira. right? So that means that is benefiting the exporters definitely. And on a RER basis too, we are actually looking quite undervalued on a 7 to 8 year perspective, because when you have a macroeconomic stability, policy stability, so and plus inflation is low, at that time, the RER model actually reflects the current valuation of the rupee. So that is a silver lining which will play out over the medium to long term. Now, in the short term, what is happening is the speculators, they get emboldened every time there is a big depreciation in the rupee, and when the central bank doesn't intervene aggressively. And central bank has rightly so this year or this financial year, they've reduced their overall participation in the market. If you look at the RBI data, because since the reciprocal tariffs were announced in April by US, it's a global trade war. And now it's a specifically Indo-US trade war, because the current tariffs which are there on India, it's quite punitive. So when you are doing a trade war, you want your currency to be your weapon, right? So RBI in the right perspective is actually letting the currency depreciate and also allowing the financial market to have some say in the overall pricing of the rupee. With inflation so benign, that is a luxury which we can take. But in the short term, what can happen is if the USD starts to close above the 90 mark, what happens? A lot of these speculators, they can start building fresh short positions on the rupee. Because when you move a big handle from 70 to 80, 80 to 90, then it can trigger further speculation. So that is something which the RBI may like to curb by coming in and intervening for a day or two and creating an uncertainty in the mind of the speculator. So that is the overall thing that is shaping up.
Okay. Anindya, Hiral on this side. So we're talking about the fall which has happened past 90.28 is what we're tracking. How much further can the rupee depreciate according to you? And what are those levels that one should be baking in, at least in terms of a range? This morning also we were having a conversation where the idea was that levels probably are not important, but the direction is going to be something which is going to be absolutely crucial now. Anindya, this was for you. Anindya, are you able to hear me? I think we've lost Anindya's feed as well.
But we can go to Gaura for that question. Actually,
yes.
Good thing we have her on here. Gaura, to Hiral's question, I just wanted to get your sense as well. Are we A, looking at the bottom? B, I also wanted to get a sense from you about what the RBI can do in the current scenario. There is this viewpoint that, exporters are going to benefit, but so does your import bill start widening a lot more. And that puts a lot more pressure on the way the Reserve Bank of India can exercise its monetary policy decision making. How do you view this?
So we do expect some relief on the currency from a depreciation perspective, because Q4 usually is a seasonally strong quarter for the INR. Your trade deficit tends to narrow. You tend to have a BOP surplus in Q4. Flows also tend to improve. So we could see some relief in terms of the depreciation pressures in Q4 if, let's say, a trade deal does also get announced. We've been waiting with bated breath, but it seems to be taking some time. But let's say if the trade deal is announced with the US, then we could have, again, temporary relief with USD INR moving down, but post that the depreciation pressures should resume. I just wanted to add that the depreciation pressure is actually a capital flow story. There has been a sharp slowdown in capital inflows into India. There's basically FDI inflows, even from the debt inflows, there is some softness. So that's resulting in the pressure. That's why your balance of payments was a negative $11 billion in Q2 versus a usual surplus number. And from the RBI intervention, I think what RBI is trying to do is they are basically facing the impossible trinity. You either choose between monetary policy independence or a stable currency, and the RBI has very wisely chosen monetary policy independence. The lesser they intervene, the less is the drain on the FX reserves, as well as banking system liquidity, because every time RBI sells dollars, it buys INR. So your domestic banking system liquidity becomes tighter. And so what RBI is doing, the lesser the intervention, less it fights the depreciation pressure, the more independence it retains over monetary policy. And from a long-term perspective, it's also a much more sustainable strategy because there is a limit of how much RBI can intervene. And as the earlier panelist said, RBI does not target levels, which you are seeing with the pace of depreciation. This year, we've seen a 5% depreciation year on year. The usual pace is around 3 to 4. So what RBI is doing, it's allowing the INR to depreciate. In part, yes, you could say maybe it's because of the tariffs. So it gives our exporters a little bit of cushion. But a 50% bilateral tariff, currency movements will not be able to take the pain away as much because we cannot let the currency depreciate to that extent. But yes, it does provide some support. More importantly, what RBI's intervention is showing you is that their ability to intervene is also limited because last year, if you note, INR was the most stable currency globally. It was thanks to the RBI, but that came at a cost. That cost was the fact that there was a buildup of net dollar shorts in RBI forward book. Now, this year, the RBI does not have that forward book as a tool to sterilize its intervention that it does in the spot market. So hence its ability to, really do massive dollar selling without jeopardizing, domestic liquidity or INR liquidity is limited. And hence the RBI has chosen to, take a more moderate intervention pattern to the dollar. And I think the question you're asking, where does the INR stabilize? It's a function of flows. And that will depend on when we start attracting FPI and FDI flows once again. Again, that's a function of domestic recovery. How better the companies do, the more investments we'll be able to attract in the equity front. And it will also require, for example, the view of foreign investors to change vis-a-vis our foreign markets, vis-a-vis our equity markets, which are viewed as overvalued. So we are not being able to attract the adequate flows.
Yeah, that's interesting, Gaura, that you say that. And, if we can just pull up the tweet that Uday Kotak just put up in terms of what's happening with the flows. If you can just have that one on the screens, because that'll tell you exactly what they mean. At $90, the proximate reason, that we are seeing the rupee at 90 is because foreign selling of Indian stocks is what we are looking at. Both FPI and PE are under FDI, under pressure. And the Indian investors are the ones who are buying. So time will tell who is smarter. For now, foreigners seem smarter, and one-year Nifty dollar returns is close to zero. But the thing is, a long-term game is what we have to see. Time for Indian businesses to shake out of their comfort zone. Pretty much relevant to what Gaura is mentioning as well right now. Anindya, coming to you, you were talking about right now that the central bank's philosophy is allowing for natural depreciation to some extent. According to you, what is that range one should be watching out for in terms of the rupee? And what level of currency volatility would actually trigger a more aggressive intervention by the RBI?
Right. See, it's already down 5%. So I would say on the upside, anything close to 6-7% or beyond, so another 2-3%. And I think it starts to have, it sort of hits the upper end of the RBI is volatility band. Because see, this year we have the comfort of the inflation because we can allow the currency to depreciate, import the inflation. Oil prices are benign. The other commodity prices are not. So that's why the hit as far as the macroeconomic is concerned is not that much from a weaker currency. But a point in time will come, let's say around 93 odd or 92.5 levels, where RBI may step in. And the Q4 being a good year for flows, we could see some improvement in the flows in the final quarter. But here we have to also consider one more part of the equation. When you're looking at USD INR, you have to also consider what's happening in the US economy. And the US economy is currently a perfect example of a K-shaped economy. It is basically the AI and the theme is pulling the overall headline growth. The rest of the consumer economy is sinking. So how long can the Fed stay away from completely pump priming the economy by cutting rates, by infusing liquidity. Trump is putting tremendous pressure. He faces election next year. The odds are stacked against him. So once US gets into the easing mode, they get into the what we call as a dollar debasement mode. I think a lot of these problems which we see for India, a country which is actually like an ocean of stability in the world, suddenly will become very attractive. So I think it's a short-term pain. Long-term, as the US economy sinks deeper, we would see actually the other side of the USD-INR equation play out, where a weaker dollar is going to benefit the flows and the currency.
All right. I want to take this question with Dr. Joshi and then with Gaura as well. The same question will apply to both of you. But first, Dr. Joshi, tell me this. How do you view the RBI's ability to ease monetary conditions in the economy at this point in time, considering the fact that, as Anindya pointed out, eventually if the Federal Reserve chooses to sort of pump prime the economy with a series of rate cuts, where does that leave the RBI?
Well, the RBI, as of now, is following what is called a glide path for the rupee. It's allowing the rupee and the market to find its own level. It does not see any reason for disquiet. There are 2 points as to why the RBI is not intervening, of course. One, there is a debt burden which we also have to service, and then we cannot really bleed in the markets and bleed away our reserves. So that is one. The second is that we think that the import sector, because the imports will become very expensive, this will actually help our own small scale industries, which have been, traditionally fairly vulnerable. And we want to help, and we want to see the promotion of domestic industry as a counterpoint. Third thing in our favor is the discounted oil. And the fourth thing in our favor, of course, is as you all know, the FIIs around Christmas cash out and go away. So I am really confident that because our fundamentals are very good, and the RBI in the coming monetary policy is certain to increase the growth estimates for this quarter, and then by February, you will find that everything is all right. We are not really concerned with whether Trump debases the dollar or not. I'm afraid he has no choice. With the kind of shutdowns that the US government has been witnessing of late, there is no other exit option for him but to make it a cheaper dollar, and then we will get in more inflows of FDI. So I am not at all worried. And the trade deal, of course, is very important. If it happens, excellent. If it doesn't happen, as I already assured you, the RBI has enough tools in its kitty as and when it becomes very necessary. You see, just now you're facing currency volatility. Let me make it clear. You are not facing a currency crisis. That happens when there is a flow of capital out of the country. When capital flight takes place, certainly RBI will bring in the heavy artillery, which it has, and it has completely a bulletproof balance sheet. So there is absolutely no anxiety on this score that I have.
Okay.
And you all know the conditions. You know why Trump is what he's doing. I mean, there are tariffs, and there are ways to squeeze us to not buy discounted Russian oil. We see no reason why we should bow down to such pressure, and we are very confident. We have seen volatility in 2014 also, when we did not have the kind of cushions which we have now.
Understood.
And we have gold, we have foreign currency, we are everything is in our favor.
Understood.
Let the FIIs go away. Let them come back, because they will come back.
Understood.
Which is the emerging market which is performing the best. India.
Right, Dr. Shri, thank you so much. Gaura, same question to you, but I also want to add one bit, which is that apart from the tools that are at the RBI's disposal to do whatever it intends to do with the currency and with rates and liquidity, communication. I wanted to get a sense from you about what can be the central bank's communication strategy come Friday when the RBI governor faces the world.
No, sure. So our expectation for the December policy is for a pause. We don't see interest rate remains a function of domestic inflation and growth. It's not a tool to manage FX. So FX, you'll have a different set of, a different toolkit. The whole argument that, let's say, currently because of the depreciation pressures on the INR. There's this narrative that monetary policy rate cuts could be off the table. It's not entirely true because for India we are an equity flow. We attract equity flows more than debt. So for that, it's a function of growth. The stronger is our domestic growth, the more equity flows we are able to attract. So from our perspective, the rate action call for December will be purely a domestic call. And we have a call for a pause because growth with that 8.2 GDP growth for Q2, if you look at the high frequency, it is showing that demand post the festival season, post the GST boost is holding up. So the need for the cut is much lower, though there is space. So we expect communication is the key tool for the December policy, and we do expect the governor to continue to indicate that there is space to ease rate based on inflation. But given the fact that growth is so robust, the need is much lower. In terms of FX, I think he'll reiterate what he said in the October policy, that they will take adequate measures to make sure that the rupee is well supported. And I think RBI will have to continue with their current strategy for FX, which is to let it depreciate. But obviously, there is a fine balancing act. Runaway depreciation is also negative from an FPI flow perspective because it reduces your dollar returns. This is fine balancing act that the RBI will have to do for currency.
Absolutely, a fine balancing act that will be required, and lots lies on the US trade deal as well as to what happens. So lots of factors that we need to consider from here on when it comes to the Indian rupee as well. But thank you, Dr. Deepali Pant, Joshi, Anindya, as well as Gaura.
One thing?
Yes,
Mira?
yes.
I'd just like to say that the only message for now is keep calm and carry on.
Absolutely, keep calm and carry on and let the exporters enjoy for some time. I think that should be the message that should be going out as well. But thank you everyone so much for joining us on the show. Always a pleasure to get you on NDTV Profit, to discuss more in terms of what's happening.